Your purchasing power just shifted permanently into assets the government cannot print. Central banks across 47 nations have increased their gold reserves by 1,045 metric tons in 2025, the third largest annual accumulation in recorded history and 152% higher than the 2015-2019 average. This is not diversification. This is institutional flight from the dollar-denominated system that has anchored global finance for 8 decades. Gold has now traded above $2,600 per ounce for 143 consecutive trading days as of January 28, 2026. Silver has held above $31 per ounce for 89 consecutive sessions. These are not temporary spikes driven by speculation or momentum trading. These are sustained elevated price levels occurring while real interest rates remain positive, equity markets remain near all-time highs, and official inflation data shows moderation. Every model designed to predict precious metal prices based on traditional inputs, interest rates, inflation expectations, dollar strength, has failed to explain the current structure. The question is not whether gold and silver will decline when risks ease. The question is what risks central banks, sovereign wealth funds, and institutional allocators see that have not yet been publicly acknowledged. And what happens when those risks materialize? I'm John A.G., and this is the Collapse Files. On January 15, 2026, the World Gold Council released its annual Central Bank Gold Reserve Survey, covering responses from monetary authorities managing $18.7 trillion in foreign exchange reserves. The findings document a structural shift in reserve composition that has been underway since 2022, but accelerated dramatically in 2025. Of the 57 central banks surveyed, 71% reported increasing their gold holdings over the past 12 months, compared to 58% in 2024 and 43% in 2023. This is the highest percentage of simultaneous central bank gold accumulation since the survey began in 2018. Total central bank gold purchases in 2025 reached 1,045 metric tons, valued at approximately $89 billion at average 2025 prices. This represents the third largest annual increase on record, exceeded only by 2022, 1,082 tons, and 2023, 137 tons. For context, between 2010 and 2021, annual central bank gold purchases averaged 456 metric tons. The current 3-year average of 155 tons represents a 131% increase over that baseline. The geographic distribution of purchases is significant. Emerging market central banks, including those of China, India, Turkey, Poland, Singapore, and several Gulf Cooperation Council nations, accounted for 87% of total purchases. The People's Bank of China reported adding 295 metric tons to its reserves in 2025, the largest annual increase since it began regular disclosure in 2019. This brings China's official gold reserves to 2,264 metric tons, though many analysts believe actual holdings are significantly higher due to unreported purchases through state-owned entities. Simultaneously, gold prices have remained structurally elevated. The London Bullion Market Association AM Fix averaged $2,787 per troy ounce in the fourth quarter of 2025, compared to $1,943 in Q4 2023, a 38% increase in 24 months. As of January 28, 2026, spot gold trades at $2,712 per ounce. What makes this abnormal is not the absolute price level. Gold has traded higher during acute crisis periods, but the sustained elevation in the absence of traditional catalysts. Real interest rates, as measured by 10-year Treasury yields minus inflation expectations, averaged 1.78% in Q4 2025. Historically, positive real rates above 1.5% suppress gold prices because investors can earn inflation-adjusted returns in sovereign debt without taking commodity price risk. Yet gold has not declined. The correlation between real rates and gold prices, which averaged 0.72 from 2000 to 2020, has broken down entirely. In 2025, the correlation measured 0.14, indicating near complete decorrelation. Silver has followed a similar trajectory, though with greater volatility. The metal traded in a range of $28 to $34 per ounce throughout 2025, with an average price of $30.84, a 47% premium to the 2022 average of $20.03. The gold to silver ratio, which measures how many ounces of silver are required to purchase 1 ounce of gold, compressed from 84.1 in early 2023 to 87.1 currently. While this is not yet at historical extremes, the ratio averaged 65.1 in the 1990s, and briefly touched 125.1 during the March 2020 panic. The sustained compression indicates silver is tracking gold's risk-off bid rather than its industrial demand fundamentals. The economic survey referenced in the title is the World Gold Council's research, which polled 150 institutional investors and 42 sovereign wealth funds in addition to central banks. The key finding: 68% of respondents expect gold to remain above $2,500 per ounce through 2026, unless there is a material reduction in geopolitical risk, sovereign debt concerns, or monetary policy uncertainty. Only 19% expect prices to decline below $2,300 if current conditions persist. This is not speculative positioning. These are institutions managing trillions in assets, responding to structural concerns about the stability of the global monetary system. Gold functions within the global financial system as the ultimate reserve asset, a store of value that carries no counterparty risk, cannot be printed by central banks, and has maintained purchasing power across millennia. In a well-functioning monetary system, gold plays a secondary role. Sovereign bonds denominated in stable currencies provide yield, liquidity, and inflation protection. The dollar serves as the global reserve currency because of its deep markets, legal protections, and the U.S. government's ability to honor obligations. Gold exists as a hedge, a tail risk insurance policy, and a historical anchor, but not as a primary allocation. Central banks typically hold gold as 10 to 15% of total reserves, with the remainder in sovereign bonds, foreign currencies, and high-grade securities. This allocation reflects confidence in the stability of the international monetary system. When central banks increase gold allocations beyond this range, it signals declining confidence in that system, either because they fear currency, debasement, doubt the credit quality of sovereign borrowers, or anticipate disruption to cross-border payment mechanisms. The current system is failing on multiple fronts. First, sovereign debt levels across developed economies have reached magnitudes that challenge long-term solvency. The U.S. federal debt-to-GDP ratio stands at 124%, up from 79% in 2008 and 35% in 1980. Interest expense on this debt exceeded $1.1 trillion in fiscal year 2025, representing 17% of federal revenue. Japan's debt-to-GDP exceeds 260%. Italy's exceeds 145%. These levels are sustainable only if interest rates remain low and economic growth remains positive. Any deviation creates a debt spiral where interest costs consume an increasing share of revenue, forcing either austerity or monetization. Second, central banks in developed economies have exhausted conventional policy tools. The Federal Reserve's balance sheet remains above $7 trillion despite quantitative tightening efforts. The European Central Bank holds $4.9 trillion in assets. The Bank of Japan owns more than 50% of outstanding Japanese government bonds. This asset accumulation has distorted price discovery, suppressed volatility, and created moral hazard where governments borrow without consequence. The existence of these bloated balance sheets signals to market participants that future crises will be met with further expansion, which erodes confidence in the long-term value of fiat currencies. Third, the weaponization of the dollar-based financial system has accelerated de-dollarization efforts. Sanctions imposed on Russia in 2022 froze $300 billion in central bank reserves and removed major Russian banks from the SWIFT payment network. This demonstrated that dollar-denominated reserves are not truly sovereign. They can be seized or blocked by the U.S. government for geopolitical reasons. This created an incentive for countries that might face future sanctions or simply wish to maintain strategic autonomy to reduce dollar exposure and increase holdings of assets that cannot be frozen. Gold is the primary alternative. The trapped participants are central banks in emerging markets that have accumulated dollar reserves through trade surpluses, but now face a dilemma. Holding those reserves in U.S. treasuries exposes them to potential freezing or devaluation through inflation. Converting reserves into other major currencies offers limited improvement. Euros, yen, and pounds face similar structural challenges. Diversifying into gold protects purchasing power but offers no yield and limited liquidity and size. The least bad option has become increasing gold allocations while maintaining minimum operational dollar reserves. This creates a feedback loop. As more central banks buy gold, the price rises, which validates the decision to buy more, which attracts additional buyers, which drives prices higher. This is not irrational speculation. This is coordinated risk management by institutions that have concluded the probability of dollar devaluation, sovereign debt restructuring, or payment system disruption has increased beyond acceptable levels. They are not betting on gold appreciation. They are hedging against system failure. The 1,045 metric tons of central bank gold purchases in 2025 represents 33% of total global mine production for the year, which totaled 3,144 metric tons according to the U.S. Geological Survey. This means central banks absorbed one-third of new supply before it could reach commercial markets, jewelry fabrication, or industrial use. This absorption has created structural tightness in physical markets that manifests in persistent backwardation, where near-term futures, pedometer, contracts trade at premiums to deferred contracts, indicating immediate demand exceeds available supply. Breaking down the purchases by region, Asian central banks accounted for 512 metric tons, 49% of total. Middle Eastern central banks purchased 287 metric tons, 27%, and Eastern European central banks added 178 metric tons, 17%. Western developed economy, central banks were net sellers of 38 metric tons, primarily through small liquidations by European central banks managing legacy reserves. This geographic split reveals a clear pattern. Countries outside the US European financial sphere are accumulating gold at unprecedented rates, while countries within that sphere are reducing or maintaining static positions. The People's Bank of China's reported 225-ton purchase in 2025 brings its official holdings to 2,264 tons, representing approximately 4.9% of total foreign exchange reserves valued at $3.2 trillion. This percentage remains far below the global average of 15% for major central banks and dramatically below the US, 68%, Germany, 67%, and France, 65%. If China were to increase its gold allocation to even 10% of reserves, still below developed economy norms, it would require an additional 5,500 tons, equivalent to 15 months of global mine production at current rates. The price impact of such a purchase program would be substantial. Examining price dynamics, gold's 143 consecutive trading days above $2,600 per ounce represents the longest sustained period above this threshold in history. For comparison, gold spent only 18 trading days above $2,000 during its 2020 peak before falling back below. The current structure suggests not a speculative bubble subject to mean reversion, but a repricing to a new equilibrium based on changed fundamentals. The standard deviation of daily gold price changes in 2025 was 0.87%, compared to 1.34% in 2020 and 1.56% during the 2008-2011 bull market. Lower volatility at higher prices indicates broad institutional accumulation rather than speculative momentum. The gold-to-silver ratio's compression to 87.1 from a 2020 peak of 125.1 represents a 30% move. However, this ratio remains elevated compared to historical norms. Between 1990 and 2010, the ratio averaged 61.1. The current level suggests silver is participating in gold's risk-off bid, but has not yet fully repriced to reflect either industrial demand recovery or its historical relationship to gold. If the ratio were to revert to 70.1, still above long-term average, silver would need to reach $38.74 per ounce at current gold prices, representing 43% upside from current levels. Analyzing the survey data, the 68% of institutional respondents expecting gold to remain above $2,500 per ounce represents a significant shift in consensus. In similar surveys conducted in 2019 and 2021, only 34% and 41% respectively expected sustained elevated prices. This doubling of bullish institutional sentiment has occurred despite rising interest rates and moderating inflation, traditionally bearish conditions for gold. The shift indicates that institutions are no longer analyzing gold primarily through monetary policy and inflation lenses, but through systemic risk and currency debasement frameworks. The real interest rate breakdown is critical. The 10-year Treasury yield averaged 4.31% in Q4 2025, while 10-year inflation expectations, as measured by TIPS break-even rates, averaged 2.53%, yielding a real rate of 1.78%. During the 2013-2019 period, when real rates averaged 0.82%, gold traded in a range of $1,150 to $1,350. The fact that gold now trades $1,350 higher than the range, despite real rates being 96 basis points higher, represents a structural shift in the premium investors place on monetary safety and counterparty-free assets. And finally, examining silver's industrial-to-investment demand ratio, in 2025, industrial applications consumed 508 million ounces of silver, 51% of total demand, while investment demand, bars, coins, and ETFs absorbed 312 million ounces, 31%. This represents a significant increase in investment demand from the 2020-2022 average of 247 million ounces. The shift indicates that silver is increasingly behaving as a monetary metal rather than purely an industrial commodity, tracking investor appetite for inflation hedges and currency alternatives rather than manufacturing activity. The first critical parallel is the 1971-1980 period following the Nixon administration's decision to suspend dollar convertibility into gold. Prior to August 1971, foreign central banks could exchange dollars for gold at $35 per ounce, providing an anchor for the international monetary system. When Nixon closed the gold window to prevent reserve depletion, it severed the last link between major currencies and gold, creating a purely fiat global monetary system for the first time in history. The immediate aftermath saw gold rise from $35 in August 1971 to $195 by December 1974, a 457% increase in 40 months. This was not driven by inflation alone, though inflation accelerated from 3.3% in 1971 to 12.3% by 1974. The primary driver was loss of confidence in fiat currencies unanchored from any tangible constraint. Central banks, particularly in Europe and Asia, responded by accumulating gold reserves as insurance against dollar devaluation. Between 1971 and 1980, central bank gold holdings increased by approximately 2,800 tons, despite IMF efforts to demonetize gold and reduce its role in the system. The peak came in January 1980, when gold reached $850 per ounce, a 2,329% increase from the $35 peg. Adjusted for inflation using CPI, this would represent approximately $3,200 in 2026 dollars, or 18% above current levels. The rally ended when Federal Reserve Chairman Paul Volcker raised interest rates to 20%, crushing inflation expectations and restoring confidence in the dollar's purchasing power. Real interest rates exceeded 8%, making the opportunity cost of holding non-yielding gold prohibitive. Gold subsequently declined 65% over the next 20 years. The critical lesson: gold's secular bull market in the 1970s was driven by loss of monetary system confidence, not merely by inflation. When that confidence was restored through credible policy tightening, gold declined despite continued modest inflation. The current environment differs in that central banks appear unable to repeat Volcker's medicine. Raising rates to 20% would bankrupt governments with debt-to-GDP ratios above 100% and trigger depression-level economic contraction. This suggests that the path to restoring currency confidence may be blocked by the scale of accumulated debt. The second precedent is the 2008-2011 period following the global financial crisis. In response to the collapse of Lehman Brothers and the freezing of credit markets, the Federal Reserve expanded its balance sheet from $900 billion in August 2008 to $2.9 trillion by June 2011, purchasing treasury bonds and mortgage-backed securities to prevent deflation. The European Central Bank, Bank of England, and Bank of Japan implemented similar programs. This unprecedented monetary expansion created fears of currency debasement and future inflation. Gold responded by rising from $869 per ounce in August 2008 to $795 in September 2011, a 118% increase in 37 months. Central banks, which had been net sellers of gold through most of the 1990s and 2000s, shifted to net buyers in 2010. Annual purchases reached 483 tons in 2011, then accelerated further in subsequent years as emerging market central banks diversified reserves away from crisis-prone developed economy, sovereign debt. The rally ended when the Fed began signaling quantitative easing would not continue indefinitely, and economic growth stabilized, reducing immediate crisis fears. Gold declined from its $195 peak to below $1,100 by December 2015, a 42% decline over 51 months. However, central bank buying continued throughout this decline, with annual purchases averaging 544 tons from 2012 to 2015. This divergence, falling prices amid sustained institutional demand, suggests that the price decline was driven by profit-taking, a momentum reversal in speculative positions rather than fundamental deterioration. The pattern across both periods is consistent. Gold rises when confidence in the monetary system erodes, driven by either policy errors, 1970s, or crisis response measures that undermine long-term currency stability, 2008-2011. Gold declines when credible action restores confidence, typically through aggressive monetary tightening or economic recovery that reduces crisis fears. The current environment mirrors the early stages of both precedents: aggressive monetary expansion, elevated sovereign debt, and rising central bank gold accumulation, but lacks a clear mechanism for confidence restoration given the constraints policymakers now face. The mainstream narrative frames elevated gold and silver prices as a temporary response to geopolitical tensions or inflation fears that will reverse when those specific concerns abate. This analysis misses the structural transformation occurring beneath surface volatility. What central banks are responding to is not any single risk: Middle East conflict, US-China tensions, European energy challenges, but the increasing probability that multiple risks materialize simultaneously in an environment where policy responses are constrained by debt and political fragmentation. What most people miss is the reflexivity between gold accumulation and dollar decline. When central banks purchase gold, they sell dollars or dollar-denominated assets to fund those purchases. This selling pressure weakens the dollar, which makes dollar-denominated reserves held by other central banks worth less in real terms, which creates incentive for those central banks to also shift into gold, which generates more dollar selling. This loop does not require conspiracy or coordination. It is simply the rational response of individual actors to changing risk-return dynamics. The second thing most people miss is the narrative control exercised by developed economy governments and financial institutions. The dollar's role as global reserve currency creates what former French finance minister Valéry Giscard d'Estaing called an exorbitant privilege: the ability to borrow in one's own currency, run persistent trade deficits, and export inflation to trading partners. Any widespread movement away from dollar reserves threatens this privilege. This creates a strong incentive to downplay or discredit the significance of central bank gold accumulation, portraying it as backward-looking nostalgia for the gold standard rather than forward-looking hedging against monetary system instability. Financial media outlets, which depend on advertising from banks, and asset managers with vested interest in dollar stability, amplify this narrative. Coverage of central bank gold purchases tends to be minimal, relegated to brief mentions and quarterly roundups rather than front-page analysis. By contrast, any short-term gold price decline receives extensive coverage framed as a bubble bursting or speculators fleeing. This asymmetric attention creates public perception that gold is volatile and unreliable, even as central banks quietly accumulate at record pace. The third thing most people miss is the role of derivative markets in suppressing price discovery. The London bullion market and COMEX futures exchange trade gold contracts with notional values far exceeding physical metal available for delivery. In January 2026, open interest in COMEX gold futures represented approximately 54 million ounces, while registered vault inventory totaled only 8.7 million ounces, a ratio of 6.2.1. This paper market allows participants to establish price exposure without purchasing physical metal, which increases liquidity but also creates potential for price distortion if trading patterns diverge from physical supply-demand fundamentals. Banks and hedge funds maintain large short positions in gold futures, often as hedges against mining company exposures, or as carry trades funded by low interest rates. These shorts must be rolled forward periodically, and during periods of stress or backwardation, the cost of rolling can become prohibitive. This creates risk of short squeezes, where forced buying by shorts overwhelms available supply. The February 2020 gold futures market saw exactly this dynamic, with spreads between physical and futures prices widening to unprecedented levels as shorts struggled to deliver metal to long position holders demanding delivery. Finally, most people miss the optionality embedded in gold. During periods of stability, gold generates no yield and incurs storage costs, making it appear inefficient compared to interest-bearing assets. But during crises, currency collapses, banking system failures, payment network disruptions, gold's properties become invaluable. No counterparty risk, universal acceptance, divisibility, durability. Central banks are not allocating to gold because they expect positive returns in normal times. They are allocating because the probability of abnormal times has increased, and gold provides optionality that becomes immensely valuable precisely when other assets fail. Sustained elevated precious metal prices in the absence of traditional catalysts signal that sophisticated institutional allocators perceive risks to the monetary system that have not yet manifested in conventional markets. Gold and silver function as forward-looking indicators of currency confidence and financial stability. When they diverge from models based on interest rates and inflation, they are pricing in scenarios those models do not capture. Historically, prolonged periods of central bank gold accumulation have preceded or accompanied major monetary system reorganizations. The 1920s saw central banks accumulate gold as they attempted to restore pre-World War I exchange rate parities, an effort that ultimately failed and contributed to the Great Depression. The late 1960s saw European central banks accumulate gold as confidence in the dollar's $35 gold peg eroded, culminating in the 1971 Nixon shock. The post-2008 period has seen the largest central bank gold buying since the 1970s, occurring alongside unprecedented monetary expansion and sovereign debt accumulation. The common thread: central banks increase gold allocations when they doubt the sustainability of existing monetary arrangements and need insurance against transition risk. The current 3-year average of 155 tons in annual central bank purchases suggests we are in such a transition period. What remains unknown is the catalyst, the timeline, and the form the transition will take. The first thing that breaks when currency confidence erodes is cross-border trade settlement. Exporters become unwilling to accept payment in currencies they believe will devalue, and importers become unwilling to pay in currencies they expect to appreciate. This friction slows trade, reduces specialization, and lowers productivity growth across the global economy. We are already observing early signs. Bilateral trade agreements, bypassing dollar settlement, increasing use of local currencies in regional trade, and discussion of gold-backed trade settlement mechanisms among BRICS nations. The second thing that breaks is domestic price stability. When central banks lose credibility, inflation expectations become unanchored. Workers demand higher wages to compensate for expected currency depreciation. Businesses raise prices preemptively. Lenders demand higher interest rates to compensate for repayment in debased currency. These dynamics create self-fulfilling inflationary spirals that are difficult to break without severe monetary tightening or currency reform. The third thing that breaks is social cohesion. Currency debasement disproportionately harms savers, pensioners, and wage earners while benefiting debtors, asset owners, and those with pricing power. This redistribution breeds resentment and political instability. The Weimar Republic's hyperinflation created conditions that enabled extremist political movements. The 1970s stagflation contributed to political upheaval across developed economies. Current populist movements in multiple countries partly reflect frustration with monetary policies perceived as favoring financial elites at the expense of ordinary citizens. Gold and silver prices are not warning of imminent collapse. They are warning that the foundation supporting the current system, confidence in fiat currencies, trust in central bank competence, belief in sovereign debt sustainability, is eroding at a pace that makes significant reconfiguration increasingly probable within the next decade. Economic survey findings document what is already occurring. Central banks are responding to structural risks by increasing allocations to assets that cannot be printed, frozen, or devalued by policy decisions. This is not speculation. This is risk management by institutions that cannot afford to be wrong about monetary stability. Gold and silver will remain elevated, not because of any single geopolitical event or inflation print, but because the conditions supporting fiat currency confidence, sustainable sovereign debt, credible central bank policy tools, dollar reserve currency dominance, are deteriorating in ways that cannot be easily reversed. The 1,045 tons of central bank gold purchases in 2025 represent the market's vote of no confidence in the durability of current arrangements. The question is not whether gold will eventually decline. In any scenario where currency confidence is restored through credible policy action, whether via aggressive fiscal consolidation, innovative productivity growth, or political reform that rebuilds institutional trust, gold will become less necessary and prices will adjust accordingly. But the pathway to such restoration appears increasingly narrow given the scale of accumulated obligations and the political constraints facing policymakers. What the survey reveals is that the institutions managing the world's reserve assets have concluded that the probability of smooth transition has declined. They are allocating accordingly. The prices we observe today do not reflect speculation about future appreciation. They reflect present assessment of risk that most participants are only beginning to recognize. This is the collapse files. The data does not warn. It documents what is already underway.